Okay. Welcome to the show, folks. Jason Bible, Texas real estate mastermind. I know there's a banking crisis going on out there. Credit Suisse, however you guys like to pronounce it. Looks like they're having a little problem there too, and they need some cash. So let me explain what's going on in the most simplest form I can, because I think a lot of the news media and even the financial news media is doing a poor job explaining what's actually going on. Like, you hear this, oh, there's a run on the banks and all the banks are crashing. And it's like, well, that's not really the whole story. You're hearing stuff from the Federal Reserve and mostly the Treasury that say things like, well, they've got, some not so great assets that they've taken losses on, but they haven't realized those losses, and we're going to backstop them. Essentially, we're doing another bank bailout. Should be no surprise. By the way, this is why I keep telling everybody there will be no real estate crash. I mean, this bank, when it all started, so first we had the Silicon Valley Bank. The second one was Signature in New York. So Silicon Valley Bank is millionaires and billionaires. If you guys remember what Bernie Sanders would say, it's millionaires and billionaires. That's what that bank is. That bank... There's a reason Peter Thiel had a checking account over there, if I'm not mistaken. I know he had mentioned, hey, get your money out. So Peter Thiel, if you guys don't know who he is, he and Elon Musk used to be business partners. And really sharp guy, big time investor. So he's a tech guy. So all these tech guys banked at that bank. That's where all their money, that's where all the VC money was. I mean, you don't do, $100 million deals, some of which is in cash, without having a bank involved. So when folks are asking, oh, Jason, there were all these uninsured deposits. Yeah, you could only insure up to $250K. So if you're running a small tech company out of San Francisco, for example, and your payroll is a couple $1,000,000 a month, it's got to run through a bank. And all of those are uninsured deposits. I don't think people realize that. Most of the assets that bank had, or the depositors, were business folks. They were running payroll. They were buying companies, selling companies, all that stuff. So what I think is hilarious is effectively the Biden administration has bailed out millionaires and billionaires. This is not mom and pop got $250,000 in their savings account. That's not what that bank was. That's a big boy bank. Lots of deals go through there, and they were almost singularly focused in the tech space. So big boy bank doing big boy deals. And if you recall, Sunday morning, Janet Yellen was on Face the Nation, and she said, "No, there's no bailout. Some banks got to fail." In fact, I think she even said it like that. Some banks kind of get smoked every now and then. And by that evening, they already had a bailout package. And what they're doing is they're backstopping the losses. So then people falsely assume, well, Jason, there's all these losses. These guys know what they're doing. Now, from a risk management standpoint, you're right. They kind of screwed some things up. But it's not all 100% not their fault. So let me explain what's going on. A bank has to make money. I know it sounds crazy, but a bank has to make money. It is a business. Period. Now, it is a highly regulated business, as there are a lot of things you can and can't do, mostly stuff you can't do. So when a bank takes on a deposit, takes on your checking account, it is also assuming a liability. I mean, it's got to maintain that checking account. It's got to maintain its relationship with you. They got to have a branch. They got to have a building. They got to have people that meet you at the door and cash your checks and all that other stuff. So it's not free to open up a checking account. Now, what do they do with your money? Well, they lend it out, sort of. What a lot of these banks do, they will invest in certain products, certain things. One of those could be bonds, and more specific, treasuries. So if you're a bank, you got a lot of money. You want that money to go to one of the safest places you can, and that's United States Treasuries. That is, by definition, one of the safest things to invest in. Now, they're not sexy. They're not going to make you a ton of money, but they're going to give you a little bit of cash flow. So I don't know if you guys have been paying attention in the last year or so, but interest rates have skyrocketed. When interest rates rise, bond prices, older bonds, fall. So let me explain what happens. Let's say we were selling these bonds last year at 3%. So for $100,000, you can get a 3% coupon. It's called a coupon. You can get a 3% coupon. So it makes you 3% a year. Well, what happens when rates go to 6%? Well, if you're going to sell that bond to get the equivalent rate of return at 6% for your 3% bond, you have to take a huge haircut on the principal of that bond. So that $100,000, and I used to be able to do bond math in my head, but I don't do it anymore. But that $100,000 bond is probably worth 20 to 30, maybe 40% less today than it was a year ago. So what happens? You have a cash shortage at the bank. You got to sell some assets, but then, those assets are all of a sudden worth 20, 30, 40% less. And you can't meet the demand of your depositors. And that's exactly what happened. Interest rates went up so fast that bonds collapsed in prices. This is one of the reasons I'm not a big mortgage note guy, because those notes are predicated on what the current market interest rate is. Meaning I'm exposed, this is what this is called, by the way. You're exposed to interest rate risk. So some of you guys out there that do owner financing or just do your own notes, and you bought some stuff about a year ago, and you're having to take some of that stuff, not even taking it back, and you're trying to trade those notes, boy, you're taking a big haircut. If I were a big, giant hedge fund, I'd be buying these mortgage notes at 6, 7, 8, 9% all day long. I would be buying them all day long. Because what's going to happen in the next 2 years? Rates are going to fall, and those instruments, those 6, 7, 8, 9% mortgage notes are going to be worth a fortune. But anyway, let's go back to what happened at the bank. So these banks have these really safe assets, but the problem is they came into a little cash crunch. Somebody in the risk management office wasn't doing their job. That's really the other kind of side of the story. Now, it has since come out that the risk manager was also chief diversity officer or something like that. That's a function that goes into HR. So they're running around doing all this silly woke stuff instead of doing something that's critical to their job called math. And this is a really easy thing to manage. How much do you have outflow? What's your inflow? What's your deposit inflow, outflow look like? Have a cash balance, have a cash account sitting there so you don't buy too many assets that are relatively illiquid. Well, I shouldn't say bonds that necessarily aren't illiquid. But when you have interest rates shoot up like that, you know that you're just not buying any more bonds. They took it in the shorts. All right, we'll get back. We'll talk a little bit more about it. It's Jason Bible, Texas Real Estate Mastermind. All right, ready to go? Jason Bible, Texas Real Estate Mastermind. All right. So you'll also notice some other things that happen. All right, so banks failing. Oh my God, world's going to end. Hair on fire. Everybody's freaking out. What you will find with these banks is a lot of times it's not just one that fails. By the way, this was completely predictable. If you are a organization, and a bank is one of those, that heavily invests in interest rate or debt denominated assets, you are taking it in the shorts for the last year. And you just pray you don't have to sell those things. Now, those treasuries are worth what they're worth. They're still a 3 coupon note. So there's still value there. You just don't want to have to sell them. I don't know what mortgage companies are doing with these mortgage-backed securities that are at 2, 3, 4, 5%. Like they are taking a bath on them. And there's a lot of them out there. I think the latest stat I saw was 70% of mortgages were 5% or less. That's a lot of paper that these mortgage brokers on the debt side would have to take an absolute haircut on to sell them. Now, they're relatively safe assets because they've got a lot of equity in these properties. And the people who've been getting loans the last 10 years have really great credit scores. So it's a pretty safe bet. It's a pretty safe asset. But from a rate of return standpoint, why would I buy somebody's mortgage that gives me a 5% return when I could go right over to a treasury? And I don't know what the treasuries are trading at right now, but let's say it's 5%. I'd rather buy a treasury at 5%. Heck, I bought a CD. I've been doing this lately because I'm building up some more cash reserves. And I park my cash reserves in CDs. I got a 15-month CD that's over 5%. I mean, it's not sitting in a checking account. I mean, it's CD, it's as good as cash. They call that a cash equivalent. It's earning me 5%. Why would I go invest in a deal that does 5 or 6%? That's why I don't get the stock market right now. Your average return for the stock market's about 8%. I'm like, man, I can take a CD, which is about as risk-free as it gets, and earn a little over 5%. I think I'm earning 5.13. I mean, that's a great return with almost zero risk. Now, a lot of folks, this is where I get into one of my favorite things I say all the time, and that is amateurs talk about return, professionals talk about risk. Because you can give me a 10,000% rate of return, but if it's extremely risky, I'm out. So you want to maximize your risk-return ratio. So let's go back to the bank. So now all these banks, all of them, a lot of them, I should say all of them, are sitting on some really low interest yielding financial instruments. Car loans, home loans, treasuries, other bonds, corporate debt. Some of this stuff, 2, 3, 4, 5%, trading really low. Well, what's the problem? If they ever sell those, they will have to reduce the price to make the return similar to what the current market price is. If I can go out and buy a $100,000 note and get a 9% return, and a year ago that was 4%, you're taking almost a 40% haircut. That's what's going on in these banks right now. It's not that they made bad deals. Now, don't get me wrong. Some of the stuff I'm reading, there is some incompetence out there. The stuff at Signature Bank, there's these videos about Signature Bank. You guys got to watch them. They're terrible. But it's not necessarily mean they're bad people and they're dumb and all that other stuff. Now, maybe they need a little bit better risk management. But what are you supposed to do if you're a bank in your charter and mandated by the FDIC that you have to buy these safe assets? They're not going out and putting it in the S&P 500. They're not buying FANGs, not buying Apple stock and Google and all that other stuff. What are they buying? They're buying these little treasuries. Municipal debt's the same way. That's another one that's supposed to be just, kind of, a municipal bond. Your school district needs $150 million to go put in a new stadium. Okay, great. Where do we get the money from? Well, let's do a bond. They put these bonds together and then sell them to like pension funds. So how many of these funds are sitting on massive, massive unrealized losses? There's a lot, but they're unrealized. Until they have to sell them, then they become realized. But if rates drop in half, then they're back in the green. So this isn't just a banking problem. It's everything in the financial system. The problem isn't that rates are 5, 6, 7, 8%. The problem is how fast they went up. That's the real challenge. It's that volatility. The Federal Reserve introduced a ton of volatility into a marketplace, i.e. bonds, that are relatively safe and don't have a lot of volatility. I mean, think about all the seniors out there. They could have spent a couple $1 million on bonds, making 2-3%, and now those bonds are worth half. So this is a much larger issue than just these two banks. By the way, anybody who's done economics for more than about 10 minutes and banking and finance knows this. Bonds are a critical part of building adding less risk or taking risk out of your portfolio. It's a tried and true method. I'm sure you guys have heard this. Hey, when you're young, invest in the stock market, buy lots of stocks. And then as you get a little bit older, you're going to want to mix those stocks with some bonds. Well, why do you do that? To take the risk out. Bonds will give you a little bit of cash flow, but they're a lot less risky. You'll hear this too. Move into dividend yielding stocks. That's another reason you do that. Stocks kick off a little bit of cash. They usually have a little less risk. Why do they kick off cash? Because they're usually companies that are relatively cash rich. So that's what's going on here. It's pretty simple. Now, what did they decide to do? They decided to walk in and backstop the whole thing. This is a bank bailout. I don't care what Biden says and what Yellen says. When they said, hey, you can borrow money from us to keep your bank afloat, us meaning the Treasury, backstopped by the Federal Reserve, you can borrow from us to make sure your depositors are made whole, which also means, hey, all of those unrealized losses, all of those bonds that are worth 20, 30, 40, 50% less, you don't have to sell those just yet. In fact, don't sell them. You guys can borrow from us. What was really interesting is how they're negotiating this right now. And that is the loans that they can take against their, quote, balance sheet, whatever's left of it, they'll allow you to do it at par value, meaning the value you paid for them. So you're not taking any losses on them. They're giving you 100% credit for what's on your books. But what's interesting is the time period. These banks will be able to borrow up to a year. Well, that's interesting. If you know that rising interest rates devalue bonds and other debt-denominated instruments, why would you only give them a year? Because they're just going to realize these losses a year. I mean, if rates keep going up, then they're just going to realize these losses a year or two from now. So the window doesn't make any sense unless, remember, this comes from Treasury and the Federal Reserve, unless they know rates are coming down. Because there's only two ways banks and financial institutions get out of a deal like this. They hold the note to maturity, meaning they get their principal back, plus they earn their little cash flow via interest for the next 20 or 30 years. I don't know what kind of bonds they bought, but let's call them 10 years. So 10 years, you get your little pile of cash back, plus you've made interest on that. So that's one way you get made whole. And you don't realize those losses. The second is if rates go down, then you'll have a situation where those bonds actually worth what they paid for them. It's Jason Bible, Texas Real Estate Mastermind. All right, ready to go? It's Jason Bible, Texas Real Estate Mastermind. We're talking about the fun banking system today and how it all works. So I know I've probably put some of y'all to sleep in your cars. Hopefully you're driving a self-driving car. If not, you probably just rear-ended someone. No, I'm just kidding. Or maybe you did. Falling asleep, talking about bonds and interest rates and all that other stuff. I know why the financial media isn't talking about this, because it's boring. This is really boring. So that's what's going on. Now, as rates rise, those instruments become worth less. If you were buying treasuries at 3% and now all of a sudden they're at 6%, they're worth about half, give or take. There's also maturity. You have to, figure in maturity. Is all kinds of bond math out there. So as interest rates rise, all of this debt that was accumulated the last 10 years at, 0 all the way to 5% is worth much less today than a year ago. So when the Federal Reserve stepped in and raised rates so quickly, a lot of these financial institutions, and we're talking about pension funds in here, big pension funds, like CalPERS out of California. I don't know what percentage of their portfolio are bonds and at what rate. It's publicly available. I'm sure you can find it. But CalPERS is the teachers' retirement fund in California. A lot of these first responder, police, firefighter pension funds load up with this stuff. A lot of individual investors buy bonds and debt-denominated instruments to take the risk out of equities. It is a perfectly normal thing to do. But when rates double in a year, every time that rate goes up, another 25 bips, another 50 bips, your debt-denominated instruments, mortgages, bonds, all that stuff is just worth less. It has less value to it. So the interesting thing is when Yellen said, hey, they've got a year to borrow from us, I was like, well, wait, what? Who cares? They're going to be insolvent if rates continue to climb, or even if rates stay the same. A lot of this stuff is going to just be worth less unless they know rates are coming down in the next year. I mean, that's the only plausible explanation that makes any sense to me. Because a year in banking and finance is not that long. So if you had to disclose to your investors, hey, investors, we bought a whole bunch of stuff and half of it is below 4%. And as you guys know, rates are at 5, 6, 7%. If we have to raise cash by selling these assets, we are going to lose our shirts, which is exactly what happened in Silicon Valley and at the bank in New York, Signature Bank. That's a huge problem. And like I said, everybody has it. This isn't bad math. It's not bad. Everyone has these bonds somewhere. This is the bond explosion. So if rates continue to go up, by the way, I was betting on a 50 bip raise in rates next week, and it looks like the debate is between 0 and 25. If we get a big goose egg, a 0, I don't think the Fed's going to hike again. I mean, because of how fast Jerome Powell is increasing rates, it's causing huge strains on the financial system. And like I said, bonds and treasuries and all those instruments are relatively safe because they're so boring. That's probably a good way to put it. They are real boring because they just pay 3-4% every year. Here you go. Here's your little check. Just like a little, it's like investing in CDs. Until a year ago, it was like, 2%, 0.5%. You had your money locked up for at least, 3, 6, 9, 12. The one I'm in is 15 months. Money's locked up 15 months and it's 5. What's the interesting thing is you guys ought to look at CDs and look at the difference in terms from like a year to 2 year, 3 year, 5 year. The numbers just collapse. I mean, they go from, 4 or 5% in the short term, let's say less than 24 months, certainly less than 18 months. And then when you start looking at 3, 5, 10s or 3, 5, 7, those rates just collapse, absolutely collapse. So it's most financial institutions' belief that rates are coming down, certainly in the next 2 years. I mean, why would you lock up your money? If I'm putting my money into a CD, I think it was like 4 3/4 or 4.85. And then they gave me like another 25 bips on top of it because I've been a member of this credit union for over 20 years. It's like a one-time thing you can take. I'm like, oh, I'll take it. It sounds great. So I lock my money up for 15 months. And then they have a 24-month that's like half the interest rate. It's like 3. Well, if I'm a guy that buys, debt-denominated, if I'm buying CDs, why would I lock my money up longer for a lower return? That doesn't make any sense at all. Well, because the bank believes that, hey, these rates are coming down. And we don't want to get stuck in a situation where we're paying out 5, 6% when rates are really 2. So the opposite works too. If they sell a bunch of instruments like that, CDs, and rates all of a sudden go to 2 or 1 or 0, and they're stuck paying you 5, they'll be out of business quick. That's too wide of a spread. So the idea here is, at least what I'm seeing and the things that Yellen has said, hey, you guys can borrow from this special financial facility to backstop your bank for a year. I'm like, well, what do they know that we don't? Why did you pick a year? By the way, that means we'll also be through the election. That's the other thing that's kind of going on here, right? Well, I guess we'll kind of be in the middle of it. We're technically in an election year now, a presidential election season. So right around a year from now, it's going to be real interesting. Where are rates going to be? If they believe these banks have large books of their business, that if they had to sell them today, they would lose money, then the belief is that in a year or so, we will probably have much lower rates. Now, I'm not saying they're going to be 0 or 2, but I don't think they're going to be 7. You know, taking a little 3, 5, 7% haircut on a bond that you have to sell, that's no big deal. I mean, it's not good, especially with the amount of money that these guys are playing with. But 40%, like that was the rumor this weekend. These banks were taking 20 and 40% losses to raise cash to pay depositors. And then somebody at the bank finally did some math and said, ooh, if we hit this critical number here, it's going to be chaos for us. We're not going to be able to get these guys' money back. We can sell everything we have because they're worth so much less than when we bought them that we just need to shut our doors. And that's effectively what happened late last week. Somebody at the bank did some quick math back, because this is pretty easy. All right, what are the bonds worth today? How many can we sell? Well, who's a buyer of 3% coupons? Not a whole lot. Not in this environment. So we have somebody we can sell all this stuff to because we got to raise cash. Well, we do, but they want a 30% off. Ooh. What's 30% off of $200 billion? And we have $170 billion in deposits. Uh-oh. And I don't know if those are the actual numbers. I'm just saying. Uh-oh. Now we're losing our shorts. So literally it's a call to the FDIC and say, hey guys, we got a little problem down here in Silicon Valley. Yeah, we're broke. we don't have any money. And these guys like Peter Thiel got a lot of money at this bank. I'm assuming Peter's a customer over there because he was one of the first ones that said, get your money out. And we got a lot of rich guys that do tech stuff all day. And we don't know if we're going to be able to allow them to pay their employees on Monday. Pretty wild when you think about it. It's Jason Bible, Texas Real Estate Mastermind. All right. All right, welcome back. Jason Bible, Texas Real Estate Mastermind. All right, so hopefully I just woke you up from your slumber on the ins and outs of banking. It's a little bit more complicated than that, but it's really just, that's, for walking around knowledge, that's plenty. So now what? You're a real estate investor. Jason, what does all this mean for me as a real estate investor? Well, we're starting to see the cracks in the financial system, meaning they really can't keep raising rates. I mean, they've already raised rates enough to break some banks. In fact, a lot of the banks we know haven't closed lines of credit, but they've stopped expanding them. Like everyone's just kind of sitting around waiting. Like, are they going to keep raising rates? What's going on here? So as a real estate investor, here's how I see it. I don't see rates going up a whole lot the rest of this year, if at all. Are we going to have some rate reductions in the next 3 years? You bet. You bet. Rates are coming down. What does that mean for real estate? Well, one of the reasons not a whole lot of properties are on the market right now is because sellers don't want to sell their homes. Real estate is a very interesting model. It's supply and demand are equal, meaning for the most part, home owners, home sellers are also home buyers. So if the buyers don't feel comfortable buying, they don't put new supply, meaning their house, up for sale. This works completely differently in just about every other market. New home construction is almost zero. So with exception to the 2000s, there's not a whole lot of new construction that puts new supply in the marketplace. Plus, the new construction isn't that significant compared to existing home inventory. So the existing homes are where we get most of our supply. And if people are not moving, if they're not buying that next house, then what happens? It's one less house that goes on the market. One of the things I'm hearing from a lot of homeowners is, you know what? I want to sell, but I got this really great mortgage. Maybe I'll just keep it as a rental property. Or I know some that just keep the property. Oh, I'm going to move across town. I'm going to upgrade, get to a little bit better house. Maybe I'll just keep this. It's a great little house. It's just not close to work anymore. So with rates being where they are, or where they were, to where they are now, homeowners are pretty reluctant to move. House prices keep going up, and the rates keep going up. So what's a homeowner do? If they don't have to sell, they just sit tight. They just sit tight. I posted an article in our mastermind group, and it talks about how this real estate market is very similar to the 1979 to 1981 market. Very, very similar. Prices kept going up. Now, inflation back then was just rampant. And I think people forget we had 2 oil crises in the middle of that massive increase in inflation. We had the Iran-Iraq war. So huge amounts of, huge disturbance in the energy markets. And energy was a much larger as a percentage of GDP than it is now. I mean, it was a huge factor. I mean, you guys remember they had the gas, this is before my time, right? So they had the gas lines, even numbered license plates could go on this day, odd were on these days. I mean, it was a wild time. So what's going to happen this time? Well, I think that's a pretty similar model. We also had baby boomers that were forming households, have kids, doing all that stuff. And then we got in the 80s and it was just wild. So what's going to happen here? Here's what I'm telling you. Here's my predictions. These rates can't keep going up. I mean, for us, it's not that big a deal. There's a couple of deals that were marginal that now don't work. In fact, we looked at an apartment complex and it needed a massive rehab. So the bulk of the deal was rehab. In fact, the rehab was 2.5 times more than the purchase price. And so the seller came to us and said, "Hey, do you guys want this deal?" And we said, "No, unless you give it to us for free. Like just the cost of construction in the loan, it'll just barely cash flow where we'd like it to." So there's some of these deals that are just going to get put on the sidelines because the debt's too expensive and rent has not caught up with the increase in rates. So my prediction is it just gets a little stagnant out there. Now, I'll tell you what I'm also seeing. In certain markets that I follow, I'm still seeing flash sales. Heck, I'm seeing some homes north of $1 million that get sold in a day. Big market moves. But what's it going to look like over the next 2 years? Well, if rates stay where they're at, it's going to be kind of like this. Very low inventory. Really hard to buy and sell houses. You are moving unless you absolutely have to, with rates with where they are. Now, the smart homeowners, if they're in the market and they find the house, they know rates aren't going to be like this forever. So they'll just go buy the house and then they'll just wait. And then as rates go down, they'll refinance. The mortgage industry has coined a new term or coined a new motto. It's marry the house and date the rate. So they're dating the rate. In other words, if you find the house you want, just go buy it. Because there's no promise when rates drop that house is going to be available. And here's the other thing. There's no guarantee that house will be available or at a price that you can afford. Remember, prices are still going up. They're going up. I mean, still going up. It wasn't as fast as during COVID. I'll give you a great example. The HAR report came out, and I think we were negative 0.6% year over year, meaning prices dropped. Oh, no. But if you pull the data, if you look at all the markets, HAR's Houston area realtors. So this is Beaumont to all the way down to Galveston, Sugar Land, Woodlands, and then Brookshire. It's 100 miles by 100 miles. It's 10,000 square miles of real estate. Largest market in the country for single family. So this is what the HAR report does. So they send out their raw data now. If you guys look, you'll find it. There's a little Excel spreadsheet. You can download it. So I downloaded the entire thing, all of the sales year over year. And I took out the neighborhoods that had less than 30 sales in a year. That takes out all the little small markets. And then I looked at all the neighborhoods that had a sales price of $350,000 and below. So I'm looking at first-time home buyers. That's where a lot of landlords buy. Airbnb is pretty common in that marketplace, although you'll find Airbnbs up to about $1 million. So I went and pulled all that data, and here's what I found. Our market, even though it says negative 0.6% year over year, you look below $350,000, it's appreciating 12% a year. That's 1% a month. So take a lot of this data with a grain of salt. You really got to look at the markets that you're in. You're not buying $1 million homes. You're probably buying a $200,000 house and renting it for $2,200 a month. That house is appreciating 12% a year. That $200,000 house is going to be worth $24,000 more this time next year. Why? Because people that need a house are just going to go buy one. And maybe they can't afford the $1 million house or the $500,000 house, but they can buy that $350,000 house with a 7% mortgage. And then one day when rates go down, they'll just refinance it. Now, what happens when they refinance it? They'll have a bunch more monthly cash. They'll be able to do some things with that cash. It'll be real interesting. All right, guys. Thanks for watching the show. We will be right back. It's Jason Bible, Texas Real Estate Mastermind.